Welcome back. This is my video about the valuation based on comparable firms. Remember that we also have two other videos. We have a video number 1 about the free cash flow valuation models. And we have a video that comes after this one, which is about information, competition, and stock prices. Let's have a look at a comparison of discounted cash flow models for stock valuation. Well, this table shows you that we actually have two types of present value calculations. We have the type that uses the dividends, okay, and we have the type that uses the cash flow. The difference between the dividend model and the cash flow model is that the cash flow model will give you the enterprise value related to the left-hand side of the balance sheet, and the dividend model is giving you the equity value. I have a separate video on the dividend discount model that uses dividend to calculate the present value of the equity. In this video, we're going to restrict ourselves to the multiple analysis concerning the enterprise value. So how does the method of comparables actually work? The objective is to estimate the value of our firm, okay, based on the value of other comparable firms that we expect will generate very similar cash flows in the future. In the next couple of slides, I have a few examples that show you exactly how this works. The definition of a valuation multiple is a ratio of firm's value to some measure of the firm's scale or cash flow. Now, it's important to know that the firm's value in this definition can be broken down in two. We can have valuation multiples based on the enterprise value, and we can have valuation multiples based on the equity value. So the PE ratio is actually a multiple related to the market value of the equity. P stands for market value of equity, or the market cap, divided by the net earnings or net profit. Okay? The PE ratio can also be computed as the share price divided by the earnings per share. Now, what can you do with the PE ratio? It actually helps you to understand whether your organization in terms of market cap is under or overvalued compared to peers in the industry. We have two types of PE calculations, one using trailing earnings and the other one using forward earnings. The trailing PE is the standard form of a price to earnings ratio calculated using recent past earnings. So the trailing earnings are using historical data. Looking at the forward PE, that uses projected future earnings to calculate the price to earnings ratio. And the forward PE is very helpful in comparing the likely future performance of similar companies in the same industry. So let's put the multiple to the test. And I have an example number 3. It goes as follows. So we have Zara Home, and they have earnings of €1.38 per stock. The average PE, so price to earnings multiple of comparable companies, is 21.3. Question: what is the value for Zara Home using the PE as a valuation multiple? Question number 2 is, what are the assumptions underlying this estimate? Good luck. So the solution goes as follows. We estimate the share price for Zara Home by multiplying its earnings per share by the PE of comparable firms. So what we're going to get is the price of Zara Home is €1.38 times 21.3. So the price of the stock of Zara Home would be 29.39. This estimate assumes that Zara Home will have similar future risk, payout rates and growth rates to comparable firms in the industry. And another one, example number 4. Food company has earnings per share, so EPS, of €2.53. The average PE, price to earnings ratio, of comparable companies' stocks is 19.3. Question: what is the value for food company using the PE as a valuation multiple? Good luck. The share price for food company is estimated by multiplying its earnings per share by the PE of comparable firms. So the estimated share price for food company is going to be €48.83. Remember what I said about using multiples? We have a multiple based on equity value. That's the one that we've just discussed in the previous slides. And we have a multiple based on enterprise value. In the market, we frequently use the enterprise value multiple based on the size of the EBITDA. Let's have a closer look at what drives the size of the multiple. Obviously, if we would decrease the cost of capital, the enterprise value would go up. Okay? If we would increase the growth rate, we would have a higher enterprise value. If we would increase the cash flow, we also would have a higher enterprise value. In sum, we can actually argue that the valuation multiple is higher for firms with high growth rates and low capital requirements. Because if you have low capital requirements, you would have a high cash flow in proportion to the EBITDA. Okay, so let's have a look at example 5. Suppose Adidas has earnings per share of €2.30, an EBITDA of 30.7 million. Adidas also has 5.4 million shares outstanding and a debt portion of 125 million net of cash. You believe that Puma is comparable to Adidas in terms of its underlying business, but Puma has no debt. Okay? If Puma has a PE of 30.3 and an enterprise value to EBITDA multiple of 7.4, then please answer the following 2 questions. Question number 1. What is the value of Adidas shares using both multiples? And question 2, which estimate is likely to be more accurate? So the answers of example 5 are: using Puma's PE, we would estimate the share price for Adidas of €30.59. Okay? Using the enterprise value to EBITDA multiple, we would estimate Adidas' enterprise value to be 227.2 million. We then subtract the debt and divide by the number of shares to estimate the share price for Adidas at €18.93. Okay? Then the answer to the second question is, because the large difference in leverage between Adidas and Puma, we would expect the second estimate, which is based on the enterprise value, to be more reliable. So if you have calculated your enterprise value and you would like to compare that to a competitor in the industry, you can use multiples. Next to the multiples that we have discussed, we can also take, for example, the enterprise value as a function of sales. Or we can take the market price of equity relative to the book value. Or we can take, for example, in the cable TV industry, the enterprise value per subscriber. So when we value a firm using multiples, there's no clear guidance about how to adjust for differences in, for example, expected future growth rates, or risk, or differences in accounting policies between firms. So that means that comparables only provide information regarding the value of the firm relative to other firms in a comparison set, or we call a comparison set also the peer group. In contrast to the multiples, the DCF actually does incorporate specific information that is unique to the firm about the cost of capital or future growth. For example, in a DCF, we need to estimate the future free cash flows of the firm. So obviously, we take into account the future growth opportunities that the firm has. So therefore, we actually argue that the DCF method has the potential to be more accurate than the use of a valuation multiple. In this table, I have included the stock price and a list of multiples. In column 1, I have the name of the company, stock price, market cap, enterprise value, PE multiple, price to book multiple, enterprise value over sales, and enterprise value over EBITDA. So this table actually enables you to compare or benchmark your own valuation of your organization with a company in the peer group, or compare it with average values in the market. So why is that? Why do we need to compare our own DCF of a company with the values in the market using multiples? Now, we know that the DCF is a very accurate and flexible method for valuing a company. However, the only problem is that it is as accurate as the forecasts it relies on. So, you could make errors in estimating key ingredients like growth rate or cost of capital, etc. And it can lead to mistakes in the valuation and ultimately to strategic errors. So that means that your DCF valuation can be imperfect. And because you would like to have a more accurate valuation, you can compare your own DCF with that of the market using multiples. Call it a sanity check as you will. I believe that a careful comparison between your valuation using multiples and multiples in your peer group will actually help you build a stronger DCF model. And also it will help you understand mismatches between your performance and that of your competitors. And of course, you can have useful discussions about whether your company is strategically positioned to create more value than other industry players are. So as a manager, of course, you seek to understand why your multiples are higher or lower than those of the competition. And therefore, a multiple analysis can generate insights into the key factors creating value in an industry. So at the end of the day, the trick is to design an accurate multiple analysis that provides you with valuable insights about your own company and that of its competitors. So a final word on the stock valuation techniques that we've used in this video. We've used the enterprise value using DCF, and we've also used multiple analysis to capture the enterprise value as well. Both techniques do not really provide a final answer regarding the true value of the stock. I think all the approaches that we have seen require some kind of assumptions or forecasts that are too uncertain. So that makes it really difficult to provide a final assessment of the firm's value. However, at the end of the day, you need to ask yourself, what is the stock's true value? And the answer is that you need to find a value that is consistent across a variety of methods. Okay, one of the most common slides in an investment banking pitch book is the football field. The football field is a floating bar chart in Excel or PowerPoint that puts several valuation analyses side by side to provide your client with the full context of a company's value using a variety of methodologies and assumptions. So our football field valuation matrix is set up to calculate the value per share. Okay? And our matrix will include the value per share based on the PE multiple in the market, the price to book multiple in the market, enterprise value over sales, enterprise value over EBITDA multiple, based on the dividend discount model that we have a separate video about, and the value per share based on our discounted cash flow model. The purpose of the football field valuation is to create a visual summary of all the valuation analysis that were performed on a company and to demonstrate a valuation range based on these valuation methodologies. So the goal of the summary is to sanity check various methodologies against one another. So this company is valued based on a combination of multiples and future cash flows. And each of these methodologies and their outcome in terms of the stock price can be taken in a best, a max, and worst case. Straight away, you can argue the share price is worth anywhere between the 10 euro and the 100 euro. If you want to derive at what you think is a fair value per share, know that the stock market is essentially an auction where investors place bids, how much they are willing to pay for a stock, and asks how much an investor is willing to sell for. So, going back to the example, this is a football field for Zara, and assuming that you are the valuator of this company and you've used a variety of valuation methods with the value per share as a result. For example, min-max for multiple PE, you've done the same for, discounted cash flow method gives you a min-max. And then what? The next step is that you're going to do some deep analysis of the underlying business, its markets, and its competitors. And based on that, the next step is that you're going to discuss with management what you think is a fair price for the stock. And in this case, the result is that management, with this analysis, thinks that a fair price for the stock is 25 euro. We have come to the end of this video. My suggestion is to open the next one, which is called Information, Competition and Stock Prices. Thank you.